Hello and welcome to Portfolio Matters. Today we will be discussing Saga, the insurer to people over 50 and provider of travel services, including cruise ships to the over 50s and particularly the over 70s. But before we do that, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Okay, Keith, tell us about Saga.
Thank you, Richard. So, why are we discussing Saga when generally on this podcast we discuss small dodgy mining shares and such like? Well, it's a classic recovery story and one where there is certainly the potential for a very good multiple return over the coming years if the company can turn itself around. Now, I must first of all thank Paul Scott of Stockopedia for bringing this stock to my attention. He obviously is much more professional than we are here, and I would recommend to everyone his blog on Stockopedia. And he covers stocks in much greater depth than we do. But anyway, he's brought this to my attention, and frankly, in the 2 days since I started buying it, it's up 10%. So we've got to sort of rush this out. Okay, so this is the share price of Saga since it was brought to market in 2017, and it is not a happy story. So the shares are down over 90%. So what does Saga do? Well, they're a specialist in products for the over 50s. As you will see, it's primarily insurance, but they have a small travel business. Actually, the travel business is now quite substantial, but it's been growing quickly. And they also have personal finance, etc., all of which is small but growing. However, it was sold by its founders to private equity. And private equity played their usual game of loading it up with debt, changing the culture to have a short-term focus. And frankly, that focus seems to have been trying to exploit the loyal user base and then offloading it onto the stock market. And I'm sure they made a lot of money out of this, but when it was floated in 2014, around half of the shares were bought by loyal customers who obviously have then lost a lot of money. So in 2020, they had a very busy year, and the former chairman and member of the founding family came back. There's a new CEO, and frankly, they have what looks like a good turnaround plan, but very importantly, they are doing their utmost to completely repudiate the values of the previous management. Its current share price is about £2.82, having been £2.50 2 days ago. The dividend yield is 0 and is likely to remain 0 for a few years yet. But it's a turnaround story with a new management team. It's got a heritage brand with very good consumer awareness. And if they can get consumers to give it another go, then there is certainly the opportunity here to build on a good brand with a growing demographic. Let's face it, the UK population is becoming increasingly elderly, and this is one of the most recognizable household brands in targeting that age group.
Yeah.
The balance sheet is stretched, but currently appears manageable. They bought 2 new cruise ships, which were delivered in 2019, 2020. The cruise business has been growing strongly and will be cash generative when it can be. Obviously, we're under lockdown at the moment. And it seems to me there is a margin of safety in this business because I think we're past the worst in COVID. And when the travel is allowed, the travel business will grow. And in the meantime, the profits from the insurance business, which have stabilized, offset the ongoing losses in the cruise ships and the travel business. So the financial condition of Saga is not getting worse. Whereas if you look at, say, EasyJet and the other travel businesses, they are bleeding cash every month. Saga isn't. Okay, so this is a breakdown of the revenues. Now, the year end is the 31st of January, so I'm afraid these figures are almost a year old, but it gives you an idea of where the business was, or what the business breakdowns are. And so you can see, actually, this is mainly an insurance business. Yeah. And it was an insurance business that was bleeding money. There was bleeding customers. Essentially, private equity came in and they attempted to exploit the customer base by giving everyone a sweetheart deal on year one. And then when they came to renew, trying to up premiums by 30%. And the advent of price comparison sites completely undermined this business model. People could see they were being ripped off, they left. And in my experience, and I had some experience of this sort of business model with the AA, who I used to think were a national utility. And I had my breakdown cover with them. And then every year they would try and up the price of my breakdown cover by between 30 and 50%, unless I phoned them up when they'd rapidly back down. But the reality was that that really annoyed me. And after a couple of years of this, I decided actually they were private equity scam artists rather than a national utility, and I was going to have nothing to do with them. And I suspect something similar has happened to the Saga's clientele, and they will have to win back client loyalty. So
people don't like being abused by organizations that they trust. And it's,
precisely. You don't trust them. No, I think trust is exactly the right word, Richard. You know, they have lost the trust of their customers and they need to get it back.
Yeah.
So the travel business, you can see, is actually very small, a tenth of the size of the insurance business. But the cruise bookings were growing quickly. And they've got, as I said, they've got these two new cruise liners, neither of which has had the opportunity to show what it can do yet. And each cruise liner, well, sorry, between the two of them, the cruise liners should produce about £80 million of EBITDA per annum. Now, as Richard is keen to point out, there's a big difference between EBITDA and earnings, but we will go into that. And the other services, personal finance, healthcare, media and mailing, contributed a very small amount, but was growing quickly. So the bottom line is, if they can stabilize insurance, or hopefully grow it again, and grow the other businesses, then you have a cheap business in a growing demographic. Okay, so what went wrong? It was floated by three private equity companies, Primera, Charterhouse and CVC at 2014, the price of £20.75. Now, frankly, that £27.75 has been adjusted because there was a 15-to-1 price consolidation earlier in 2020 because the share price had got so low it became an embarrassment. And as I said, the private equity companies loaded the company with debt. But more importantly, they just destroyed the culture. They made it, you know, a company that attempted to exploit its consumer base rather than providing them with value. And then what really did for them was when the 2019 Brexit, they warned on that the travel business was also going to fail to meet expectations. Then you had basically all parts of the business underperforming and the share price collapsed. Okay, so what happened in 2020? Well, at the start of 2020, they had a new CEO who was previously the CEO of Superdry. They then had a rescue capital raise, and raised 150 million. Now, what's interesting is the way that was done. So Sir Roger de Haan, who was part of the founding family, committed at least 60 million pounds at a price equivalent to £4.05 now. So at a significant premium to the current share price. And he did that as a show of faith in the long-term future of the company. As I said, there was then a 15-to-1 share consolidation, and it also rejected a takeover bid at a price equivalent to £4.95. So as I said, the share price is currently about £2.80. And that takeover bid was by a US financial consortium. And the company considered that to be opportunistic and to significantly undervalue the company.
Okay. Interesting.
It then took a delivery of its second cruise liner at, frankly, a terrible time. The Spirit of Adventure. And it's announced this turnaround plan. But obviously with the 2 cruise liners comes a lot of debt. Okay, so the turnaround plan, you know, it has the usual suspects in it, but there are a couple of interesting things. So number one, they managed to reduce the number of management layers from 17 to 5, which I thought was extraordinary.
Good going.
Yeah.
Good going to get 17.
Well, exactly. That does make you wonder how they've got to get 17. The other thing is, when it comes to debt reduction, their objective is to reduce total debt leverage to under 3.5 times EBITDA.
Mm-hmm.
And until they achieve that, no dividends. That is the overriding objective.
Right.
Okay, and so this is what they call the new plan. Transforming Saga, experience is everything. And what I thought was interesting about this is how they are completely repudiating the legacy of the old management. So dilution of the original culture and lack of clear performance expectations, inconsistent focus on the customer and core drivers of shareholder value, poorly made investment and lack of delivery across the business, excessive levels of debt. Frankly, it sounds like they really didn't like the old management. The new guys have come in. So Roger de Haan is back and he is despairing of what he's finding, which I find quite positive, actually. Sounds like they're, you know, a new broom has come in.
Yeah.
And you can see here, this is like, there are several pages of this in the annual report, frankly, but, you know, it's all has the feeling of hopefully a new era. And if you see here, if you can read it, Spirit of Discovery achieved 20 million in EBITDA for the second half, in line with guidance for 40 million EBITDA per ship per annum. So 2 ships, 80 million EBITDA.
Mm.
Okay, so looking at each sector, insurance, they have stopped hemorrhaging clients, which is good. They now have, for first time in years, they have an increase in policy sales, customer retention rate of 80%. They have, as part of the turnaround plan, they've instigated these 3-year fixed price policies, and those are selling well. In fact, now I've heard about them, that sounds like a good idea, and I might check them out myself. I am sadly in their demographic these days. Direct customers account for 59%, and obviously direct customers are much better than going via price comparison sites, and that is growing. And obviously all the insurers have had quite a good year, as they've sold them travel insurance and nobody's been traveling, and they've sold them car insurance and nobody's been driving. So, you know, this year has been unsustainably good for a lot of the insurers. Okay, so with travel, retention rates remain high. So people that go on the cruise tend to come back. Their cash burn is 6 to 8 million a month. And as I said, that is being offset by the profits in the insurance business. And overall, the business is profitable currently. they've instigated a policy whereby the cruise passengers will have to show that they've been vaccinated. And so as a consequence of that, you see on the bottom line here, advanced bookings have been astonishingly strong. So total bookings for, as of 31st of January 2020, were 78% of target for the coming year. You know, given that nobody can travel, I think that's an absolutely astonishing number. So people are desperate to get out and go cruising. Yeah. Now, the big question is they've got a lot of debt, but there are no immediate problems. Cash as at 31st of December was 51 million, plus they've got an undrawn revolving credit facility of 100 million. So they've got no immediate liquidity problems. They reduced the cash from 461 million as of 31st of July to 271 million. That's mainly because of the placing. They are within covenants. The covenant on the debt is net debt to EBITDA of 3.0 times versus 4.75 times. Mm-hmm. But including the ship loans, debt is big, 785 million. Okay, the ship loans. Well, the ship loans are asset backed, i.e., if you don't pay us, we take the ships back. But, you know, what are the lenders going to do with two huge cruise ships? So I suspect that the lenders are not going to be terribly keen to take back these ships and will more likely come to an arrangement with Saga. So the two ship loans amass to a total of 514 million. And the covenants are debt service at greater than 1.2 times, and the actual was 3.8 times, so lots of space, and interest cover greater than 2.0 times, and it was actually 5.4 times. So no problems, no immediate problems. In addition, they are talking with the lenders about deferring some of the principal payments. Now, all they would say is these are early stage discussions. But, you know, there is the possibility they'll push back the payments. Yep. Now, Richard asked me, what was the average life of a cruise ship? And they say 30 years.
Right.
But there are a few still going. So bottom left is the Sea Cloud, which is now 90 years old, still going, looking very nice.
Piece, but yeah.
Yep. And the one on the right, the Astoria,
right,
75 years and still going.
Okay.
So, you know, they can go on for a very long time. His other question was, how often do they need to be refurbished? Essentially, they go into dry dock every 5 years. So this all relates to the question of EBITDA and the 80 million of EBITDA that the two cruise ships will throw off a year. There will be depreciation and there will be refurbishment costs, etc., as well as debt servicing. But if you think that they've got debt of 540 million and it's going to throw off 80 million EBITDA per year, so it would take roughly 7 or 8 years to pay off the debt if you took all of that money and assigned it to cash and interest repayments. But then it's assuming that you also have to have refurbishment and maintenance costs, let's say 10, but then you have 20 years in which the ships kick off a lot of cash. So that's the model.
Good.
Okay, so positives, demographics. One of the most recognizable names in a section of the population that is only growing, and which now, sadly, I am in. It's still so it still remains profitable despite COVID disruptions, although frankly barely profitable. The profits for the insurance are more than offsetting the losses from travel. Financial position looks stable. It's within debt covenants. It's got a new management team, including one of the members of the founding family who's invested 100 million at a significant premium to the share price, all of which is a big vote of confidence. And as I said, customers, certainly to the cruise business, are loyal. They're advanced booking. And in the underwriting and insurance business, the customer base has stabilized. Negatives. Now, it would be wrong to assume that you can just get back all the customers you've managed to annoy over the previous 5 years by trying to rip them off and sell them overpriced insurance. That will all take time, and it will take time for the customer base to for the management to regain the trust of the customer base. Half of the shares were taken up by loyal customers who have then lost 90% of their money. Also, when we look at the share price graph and you see the share price coming down from £30 to £2.80, obviously we've now doubled the number of shares in issue. So, if the company were to get back to its previous levels of profitability, that would be equivalent to a share price of £15, not 30.
Significant uplift, but over the course of a number of years, presumably.
Yeah. It's obviously still highly indebted, and it's a turnaround situation. You have to believe that the new management can execute on their plans. But currently, everything I've seen actually is quite positive. And I like the fact they really are making no excuses about the aims of the previous management. So the debt, there are no immediate debt repayments. The bond is due to be repaid in 2024 as the first one. So they've got no immediate cash problems. However, again, we just don't know where we are with COVID. It is possible that there will be a ban on travel because of all these new variants. You just don't know.
I think the issue, I guess, is if the UK succeeds in getting its vaccination program completely rolled out, and we don't have a problem with variants that bypass the vaccine, which I think is perfectly plausible. The issue then is, will these cruise ships be allowed to dock in foreign ports? And because if they can't, then the attractiveness of going on a cruise substantially reduces. Very, very difficult to know, at what point that issue may disappear. It may disappear this summer. It may take quite a lot longer than that. It's an unknown, isn't it?
Absolutely. But you would hope, if everyone on board has been vaccinated, that both destinations and the cruise ship operator will be more amenable to allowing people on and off the boat. And also different jurisdictions have different tolerances. So, Greece has generally been quite amenable to having its tourists back, but, Italy less so. Okay, so in summary, I think this is an interesting recovery situation, and the shares are bombed out because they've lost the trust of customers and shareholders. So I have bought actually a decent chunk of this over the last few days. I started buying it £2.50, and I had some limit orders to buy some more when it went below £2.50, and I woke up to find it opened at £2.70 and it's now at £2.82. And what had happened was that Paul Scott had tipped it again, and Credit Suisse had come out with a positive note. So I've held my nose and bought more. And obviously, if there's if they can execute on this turnaround plan, then the shares have a lot of potential headroom.
Well done, Keith, for identifying them, and thank you for a very interesting explanation of the company.
You're welcome. So I hope you enjoyed that. We promise to get back to dodgy mining companies soon.
Yes.
In the meantime, please press like and subscribe to the channel, and we hope to see you again soon. So it's goodbye from Richard Wheater.
And goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.